Welcome back to the channel, everyone. Today I want to talk about another corrupt broker or trading platform that you should stay away from. I also want to talk about the mainstream media lying about the DTCC. So stay tuned and let's make some money. But before I dive in with the key information, I wanted to get into the Christmas spirit. Over the next few days, you're going to see various different kinds of Christmas attire, so I hope you enjoy. But for now, let's dive in with the key information. So, Trading 212 have just spoken about their share lending. Ray asked, what is this pop-up on my app today? I don't want my shares to be lent out and be used, but there's no option to opt out. So Trading 212 recently updated their terms and conditions, requiring that the user provide their express consent to the securities lending arrangement. In summary, you agree to lend shares in your account to Trading 212, and that Trading 212 will on-lend your shares to a reputable third party. And you further agree that you will not receive fees or payment for lending your shares to us. So the actual verified Trading 212 account replied to this post and said share lending was launched last year, so the pop-up doesn't suggest the introduction of a new service. We have improved the clarity of the relevant provisions in our terms of business. Ray obviously said, well, I want to opt out. This is an introduction after me joining, a new term in a contract I have not agreed to, so please confirm you will not lend out my shares. Trading 212 again replied to the comment and said if you decide not to consent to the share lending agreement, your account will continue to be in position close only mode. They said you won't be able to open new positions, but you can close existing ones. And therefore this is just another broker in the long line of brokers that are forcing clients to accept share lending, or basically their account is either terminated or put into position close only mode. Again, this is just another way for the brokers to effectively turn off the buy button and prevent you from buying shares in AMC or GameStop. Right now, Moomoo are currently giving away a free iPhone 13 Pro and many other goodies every single day this week when you sign up. On top of that, you also get the standard 5 free shares valued up to $17,500. Each free share is valued up to $3,500 each. You get your first free share when you sign up and open your Moomoo account. You get your second free share when you deposit any amount, even if it's only a single dollar. And you get the final 3 remaining free shares when you deposit $2,000. And be sure to deposit at least $100 on Moomoo and check back every single day to see if you've won that free iPhone 13 Pro. Moomoo is also a brilliant investing platform with free real-time level 2 market data. They've got advanced charting tools. They've got 24/7 real-time financial news so that you don't miss the biggest headlines, and a global investment community so that you can get some new stock ideas. I also wanted to touch on Peter Hann's latest LinkedIn post. He said, I'm sharing this just to illustrate how mainstream media papers over issues regarding so-called meme stocks. He said this article claims to quote officials from the DTCC, as in DTCC employees, but does not provide the spokesman's name. The article quotes saying the official said it was impossible to sell fake shares in a company such as AMC, which is registered with the Securities and Exchange Commission, because the trades must be conducted by an authorised broker-dealer. The transactions go through the DTCC and the SEC-approved clearinghouse. And Peter says, and yet, did I not just post an article about a month ago detailing a New York financial journalist with over 40 years of experience noting that trades can clear outside the DTCC's purview, such as if a market maker or dark pool can find offsetting trades. There's also tons and tons of trades that clear through OTC markets and through private markets, and therefore not necessarily going through authorised broker-dealers or SEC-approved clearinghouses. And he also says, more to the point, the SEC regularly posts fail to deliver data, which indicates that AMC has significantly more fails than would be normal of its size and capitalisation. These fail to delivers are quite literally fake shares being sold in a company because those shares haven't yet been located, and that's why they failed to deliver. And he said, and yet this article completely ignores that aspect, and yet consistent fails to deliver are symptomatic of naked shorting activity. Nor does this story reference the Department of Justice investigation just launched against suspected short selling abuse. And he said, nor does this story reference the myriad of rule filings the DTCC, NSCC, FICC and OCC have listed this year. Why the sudden rush of rules that require more margin, more capital requirements and require more detailed reporting? In short, while the Wall Street Journal article does not have the obnoxious bias presented in Motley Fool or Seeking Alpha articles, it falls short of objective reporting, and it's hard not to see the bias seeping out between its pages. He said, sorry Wall Street Journal, I am not an amateur investor, and I can smell what's cooking, and it stinks. Now, Marco Metzler also did a bit of due diligence and research, and he said, I'd like to bring attention to a blog post on the latest Wall Street Journal article on AMC. He said, Frank Nez, the author of this separate blog post, has determined that Ken Griffin indirectly owns the Wall Street Journal by owning News Corporation. And therefore, it's not surprising that the Wall Street Journal is posting FUD articles like this that are full of complete lies. He specified by saying News Corp is the parent company of the Wall Street Journal, and strikingly, it contains more media companies which have also been attacking AMC all year as well. So clearly, Ken Griffin doesn't just own the Wall Street Journal, but he also indirectly owns many other news companies as well. And that's exactly why we're seeing so many FUD articles all the time, because the mainstream media is heavily influenced by Citadel and specifically Ken Griffin. Now, I also wanted to talk about the potential margin calls coming today, or more loosely, sometime this week or next week as well. We can see so far from this morning that the Dow futures, the S&P 500 futures, and the pre-market activity on pretty much all stocks across the board is down heavily. JP Morgan also made a recent post about market and volatility. They said over the past 4 weeks, small caps and value stocks entered a correction and therefore sold off more than 10%. High beta stocks have sold off more than 30%, entering a bear market. He said, in fact, there's a paradox that on average, US stocks are down 28% from their highs. Most highs were recorded in the first half of this year, and the median stock is down 21%, while the market is up 22% for the year. Now, the reason why this is happening is because the S&P 500 is literally being carried by a few companies like Apple, Microsoft, Amazon, and Google. Because these 4 companies are still rising or haven't fallen as heavily as many other companies, that's why the S&P is still trending upwards, even though many other companies in the S&P 500 and in the wider market are down significantly from their highs. Because these few 5 companies hold around 20% of the weighting in the S&P 500, and therefore the overall S&P 500 market is going to move broadly in the same direction as these 4 or 5 stocks. JP Morgan said such a divergence is unknown to us and indicates a historically unprecedented overshoot in selling smaller, more volatile, typically value and cyclical stocks in the last 4 weeks. JP Morgan said the narrative for the sell-off is related to Omicron and the Fed, while actual selling comes largely from de-risking and shorting from equity and macro hedge funds. And therefore, many hedge funds and institutions are trying to de-risk because they know how over-leveraged the market is and how likely a market crash is as well. They said, yeah, there's been aggressive shorting, likely in a hope of declines in retail equity positions and cryptocurrency holdings. While in fact, both of these markets and retail investors have shown resilience in the past weeks. One should note that large short positions likely need to be closed before the seasonally strong January. And they've said that January is likely to see a small cap, value and cyclical rally. And given that market liquidity is dwindling, the impact of closing shorts may be bigger than the impact of opening them when liquidity conditions were better. Therefore showing that a short squeeze is absolutely possible for now in December or for the next few weeks in January. And therefore it's very, very possible that there could be a lot of liquidations coming over the next few weeks as the wider markets continue to decline and as an AMC MOAS or short squeeze happens. Now, I also want to talk about Spider-Man's staggering $253 million opening weekend and how this stacks up to other films released this year and in previous years as well. If we go back to the 2019 box office and look at that opening weekend, the highest grossing film for the whole of 2019, so pre-pandemic, was Avengers Endgame with $357 million. But the second highest grossing opening box office weekend was The Lion King with only $191 million. And therefore that makes the new Spider-Man No Way Home the second highest grossing opening weekend box office film since 2019, pre-pandemic included. And with this weekend's global tally, it ranks as the third biggest worldwide debut in history, behind Avengers Endgame with $1.2 billion and Avengers Infinity War with $640 million worldwide. And therefore, this isn't just one of the biggest films post-pandemic in 2020 and 2021, it's already one of the biggest films in history, including 2019, 2018, 2017, 2016, and any year previously. That is absolutely huge, and it just goes to show that movies are absolutely not dead. Based on that, there's been some beautiful idiot who bet $13 million that we go to the moon before January 21st by buying 56,000 call options. I think it was for the $40 strikes. Clearly there is a lot of expectation that the squeeze happens before January 21st, either sometime over the next few weeks of December or in the first few weeks of January. Guys, be sure to let me know down in the comments below what you think about Trading 212 being another corrupt broker, and also what you think about the mainstream media lying about the DTCC. And if you want to stay up to date with all of my latest stock and crypto picks, or if you just want some help with AMC and GameStop, be sure to check out the Patreon and the private Discord, linked in the description below, and become part of the team. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!